Welcome back to Infinite Banking with today's video. We're going to be talking about Security Mutual. And Alden, we get asked all the time what insurance companies work when it comes to infinite banking. And we've put this series together to give the most comprehensive look at each insurance company, the company strength, how their loans work, how PUAs work. We look at illustrations, cash flow, front load, and we're looking at loan considerations. We're looking at the what agents would want to know if they were looking at doing business. And then we give the pros and the considerations and then a summary. This has been a labor of love for you. I'm excited to just get people's feedback on this because we've done and are trying to do our best to be as neutral as possible. Just give the facts. And then people are smart enough to say, I'm super interested to learn more about this. And obviously, as people work with us, it's very common in our process to give people options. And this series will also help color in the different type of companies that have options. So without further ado, let's talk about Security Mutual, and I'll hand it over to you.
Awesome. Well, Caleb, thank you so much. Guys, I'm excited. Security Mutual, let's dive into it. So when we're looking at Security Mutual, some big highlight numbers we got to understand is they've been doing business a long time. 1886 is when they were founded, and they've been paying dividends almost their entire time they've been around. So about 133 years. Now, this is unique for this particular carrier. We're going to hit on this about 4 or 5 times in the presentation, but I would consider them niched. And what I mean by that is they are very public about their support of IBC. They have it in their public marketing. They talk about bank on yourself and a lot of other the slogans or their trademarks, I guess you could say, for different banking organizations that do business with Security Mutual. So I think that's very interesting from an insurance company's perspective. All right, so diving in, there are some key metrics that we like to pay attention to when we look at an insurance company to do business with. The first is, hey, are they paying a dividend? And is it a healthy one? Well, $21.5 million, it's a small one comparatively to the industry, but it's healthy. It's $21.5 million paid back to their policy owners, which is a big deal. Now, they also have a dividend interest crediting rate of about 5.4%. This is the next number, right? This next number is the lapse ratio, a newer number on the channel. Lapse ratio is if you cancel a policy, you do a 1035 into another carrier, or if the internal charges in that product are higher than the cash value, the policy lapses. And so in those 3 examples, we can pull a lapse ratio. And what we're seeing from Security Mutual, the average over the last 5 years, is around 7%. It's about a 35% increase above the average. And something I will note, just because I like to look at these numbers on the back end here, is the lapse ratio for this carrier has actually been increasing for the last 5 years. So not exactly sure why, but that is something to pay attention to as well. Loan recognition, they are a non-direct recognition carrier. And this is the interesting part is in the ratings section, they don't have a Comdex score. So Comdex score, as you may recall, is a conglomerate score. It's usually 5 different rating agencies pulling the scores together and then attaching it to an out of 100. So Comdex in our line of business, we usually look for 90s and above. We have a couple that are in the 70s and 80s as well. Security Mutual is just too small. They don't have a Comdex score, but what they do have is an A- rating from AM Best, which is a good insurance rating. And then this is could be a concern as well, is the Weiss, or somebody tell me how to say that, safety score of C-. The thing to understand is that this is the lower third of the fair category in the safety rating score for this insurance industry.
Alden, I'm curious, did they publish that C- score, or is that something that you found in digging?
I had to look it up. Yeah, they published on their website the AM Best rated score. I had to look up the Weiss rating.
Okay. Yeah, it's interesting to see how some of these work, and it's one of those. It's like it's not like you can just throw out the ratings that you don't love, because I would imagine that as we're going through, that's definitely something that we highlight, and it's definitely something that would need or would want to be disclosed to a client going through. Obviously, life insurance, one of the biggest pitches is you want it to be a safe place to put your money, and so obviously C- is something I'm hoping can be improved over time.
Yeah, and we have to understand too that these ratings come out every year and carriers fluctuate. Like Mass Mutual used to be a 100 out of 100 Comdex score. They're not anymore. They're a 98, right? So things change over time. They will fluctuate. So I don't know where they were last year. This is where they are today. Now, this is something interesting. So you'll notice in the series, I usually put just an interesting fact at the bottom of the slide. Because Security Mutual focuses so heavily on the infinite banking community, they market to it, it's their niche that they want to do business with, their loan ratio, so the amount of their portfolio, all the money they have at the carrier that is invested, almost a quarter of it is in policy loans. This is an outrageously high number as compared to some of the other carriers we've looked at. So if you see on your screen here, Mass, Penn, Guardian, New York Life, One America, they all average around a 5%, 6%. And then Security Mutual is here 4 times larger. The other one that we see that's also a little bit large is another carrier that has a very strong infinite banking community. Another one actually that I didn't put on here is Emeritus. So those 3 carriers have loan ratios above 10%. So you can kind of correlate the reason for that because of the type of niche market that's attracted to that carrier and their products.
All right, so here's my take on this slide is they're a small company. That can be a good thing, can be a bad thing, but they're definitely a small company. It's hard to compare to even major mutuals. Their dividend interest rate seems to be competitive. Their 7% is definitely above average, which is not ideal. Non-direct recognition's great. AM A minus, good. AM best score, that's good. It's not great. And then obviously to have any type of rating company give you a C minus is not something that's awesome. I wonder if their large loan portfolio has anything to do with that. One thing, if we just wanted to nerd out, Alden, is having high loans. On one hand, people could say that's this positive thing because it's as guaranteed as future interest comes because you have a liability on your balance sheet. So like that can be a positive. But the negative comes in from a cash flow standpoint. If too much of your asset is tied up in loans, it could potentially start putting some handcuffs on an insurance company. And so that would be, I don't know where they start to freak out, but that would be something to note. And there are benefits of being with a big company that have low loan reserves because that's just less of an issue.
Yeah, absolutely. And I think the interesting thing too that you mentioned here is that 22.5% on loan, right? One of my mentors told me that a policy loan is the safest insurance investment that they can make. It's the 100% guarantee that they're going to get a return, either in paying out less or they're going to get the loan paid back with interest. I agree with that. But compare that to another safe asset that they would compare to a policy loan, like a bond. The benefit of a bond is you know when it's going to mature. And if you get into some trouble, you can sell it. You can't do that with a policy loan. We don't know when it's going to be paid back. The expiration date on a human is kind of variable, right? So we have these things that do affect the overall rating, and perhaps it could be paying into the safety score there. Now, for Security Mutual, their positioning around IBC is actually very strong. So they're well known, kind of. They're a small carrier, but for those who do know about them, they're very well known for infinite banking, and this is because they're very vocal about this. This is one of the only insurance companies, actually, I think the only insurance company who's technically forward-facing, public viewing, vocal that they want this type of business. And so because of that, I think to some degree, hats off to them, but also you have to think and wonder, why are they doing that? Is that okay, right? So it's just an interesting thing to think about. But as we see, their products are very well built for this type of policy. Now, the naming of these products, I find it absolutely hilarious. They name these the Whole Life for You with 4 and U misspelled, but it's the LP100 product, and we're going to dive into some numbers here.
They had some Gen Zer come in and, instead of saving money on a consulting gig, that's the names they came up with it. I will say I kind of chuckle inside because I think in one of the series I made an ultimatum where I was like, no insurance company would ever endorse anything like infinite banking as a company. And then look at me eating my words. So I was wrong. And there's one insurance company that not only is just super supportive, but straight up from a company level endorses this. So I stand corrected.
All right. So diving into the numbers, guys, we're going to look at cash flow design, insurance policy, and then one that is a front load design. It's the same product, but we're going to look at those 2 different bills.
And again, if you're new to this series, cash flow means every single year you're putting in the same amount of money. Obviously, there's flexibility within that, but that would be the target. And then the front load is someone who's got money up front, who's putting a lot of money up in year 1, and then every year after that is putting less. And it's flexibility within that mode as well. And those are the two things that we're looking at. And then at the end of the series, we're comparing all the insurance companies that we ran numbers with, and we're going to have one video that kind of compares them all.
Well, as a cash flow design with Security Mutual, they do have let's say a below average early cash value in the policy. We're looking at 75 to 85% in a short funding time frame for cash value. Now, they use term insurance just like any of the other carriers. And when I look at the efficiency of the product, what I typically see is if we're going to do a short pay with this particular product and carrier, it's going to be most efficient. We're going to fund up until that term rider falls off. Growth-wise, About 3.25 to 4.25 is what we're looking at. Rough numbers here, internal rate of return. So this is again on the lower side of average from what we've been seeing, but definitely stick around for that comparison video we're going to do at the end. All right, guys. So jumping into the numbers here, we're looking at that same 40-year-old male. This is a preferred non-smoker, one level above standard. And we're funding with $50,000 a year for 20 years. After 20 years, we start putting in $0. We're having the policy pay for itself. This is called an offset. So right off the bat, when we start looking at the policy, we're putting in 50 grand. We end up with about 42,500 cash value projected at the end of the first year. So this equates to around that 84% cash value number, kind of on the higher limit of what I've been able to get with this particular carrier. All right, so looking at this insurance policy, we have really two metrics that we want to comment on today. One is the capitalization point. The other one is the break-even point. Capitalization, all it means is it's the point in the policy where I'm putting in $1 and we have more than $1 of cash value available in that year. So when we look at this illustration, we're looking for a point where we put in 50 and we have more than $50,000 of increase in that policy year. This is happening right here between years 3 and 4. So really a year 4 capitalization point, we've got more than 50 grand of growth. The second metric we look at is going to be break even, which is going to be out here in year 6. Now, these two numbers are break even in year 6, as well as the early cap point in this. It's actually fairly competitive. But where we will see is the long-term performance is not quite as competitive as some other carriers. But early on, so far, they're looking pretty solid.
Yeah, I would just note the same things that you were saying is early on looks like it's about 85% cash value. That's can be strong. And then the capitalization, the break even is in the ballpark. But knowing that the internal rate of return was what you stated, I would have bet that over time there's going to be a big difference when we do the comparison video. And again, I want to note that these are all illustration. So this is not saying that this is actually going to happen. And so I think we need to continue to remember that. And we'll make sure to very much mention that in our video when we compare all the numbers.
All the projections. That's right. Awesome. For those of you taking notes, before we do that comparison video, look down at the cash value at the end of 20 years, about 1.51, death benefit about 3.61 million. Now, when we're looking at front-loaded insurance policies, what I typically see is somewhere between 80 to 89% of short cash value in the very first year after funding. Now, you can fund long-term, and that growth is good. It's on the lower side of average, but it's not bad, in my opinion. And so the product itself, as you can tell by the positioning of the company, is built for this type of insurance product. They are competitive. All right, so 40-year-old male, $100,000 the first year, $50,000 a year after that. The very first year, we've got that high end. Actually, we're pushing just barely over 90% of the total surrender value. And so if you're a little bit younger, a little bit healthier than this, we might actually be able to push that 90% threshold, maybe up to 91%. When we're looking at the annual contributions for the policy, year 2, moving forward through year 20, we are doing that $50,000 a year number we've mentioned before. So those two markers that we look at, right? The capitalization point, when does that happen? It's actually happening in year 3. We jump from 236 to 287, so just over 50 grand of increase. And then from the break-even perspective, we almost do it in year 5. We're about, $1,500 short of breaking even in year 5. So if the dividend fluctuates in the upward direction, we got a year 5 break here, which is pretty great.
I'm looking at this and the same thing that I said in the cash flow. It's like early 90%. It's pretty competitive. The fact that it breaks even, or not breaks even, but it capitalizes in year 3. That's great. And then year 6, break even standpoint, I'm looking at the death benefit and going, holy term rider. I'm sure that's very interesting. Yeah. And you're seeing a dramatic drop, which is kind of unique that it drops so much, but you continue to keep the funding after year 11 and beyond. So that's unique design.
Yeah. If we had to do a comparison, I'd think it's pretty similar to Lafayette Life and how their products are designed. We'll have that big drop after the term drops off, but you can still fund a decent premium, which is pretty great. Going out 20 years, for those taking notes, end up with a cash value projection of about $1.62 million and a death benefit projection of about 3.84. Now, in true IBC niched market fashion, they've got cash value access extremely quick, lightning fast, in my opinion. We've got loans available after 10 days of funding. And so that is the fastest in the industry that I'm aware of. If I'm wrong, somebody tell me in the comments. nicely, please. But moving forward, we have a non-direct recognition system. They do have a variable loan rate that will be announced every year. Small loans, and I mean extremely small loans, can be initiated through that portal, which is about up to a $10,000. Interestingly enough, most carriers are allowing loan repayments. This is the only carrier that I know that they limit their loan repayment to $10,000 as well. And so if you go through the portal, you're kind of limited. Otherwise, larger loans, you have to go directly to the carrier or work through your agent. Your interest accrual
Interesting.
is
Yeah.
that daily accrual as well.
Okay. Yeah, that's a very fast. That's great. That's a plus. A non-direct recognition plus. It's easy. See, it makes our life easier when you're non-direct. It's a lot easier for us to explain. Easy small loans. Yeah, 10K. What's the typical that you see with that can be done online?
Usually
It's
it's up
like
to about
50K.
50,000. Yeah, if they offer the option, it's 50,000.
And then the idea of paying back above 10,000 going through your agent or to the company, I also don't necessarily see that as a major plus. I guess third party lending is a thing across the board. So I wonder how many people that do a lot of infinite banking do third party lending, because that doesn't seem like, as for being a company that they're like, we want to be like, we endorse infinite banking. It doesn't sound like they're make it that easy. And with that said, they have 22% of their loans outstanding. So there could be a way that this is like they're intentionally making it hard. This is actually a potential example that I kind of alluded to early, whereas like this could be a restriction that they do intentionally because they don't want to get their loans of 22% growing. Just a thought.
Yeah, it is. It's an interesting thought to kind of dialogue and think through. But I'll push back a little bit on the intentionality of this design. I actually think this is still marketing to the IBC community. Traditional IBC policies, right? They're people who are refinancing and recapturing interest instead of paying it to a bank. So those repayments, they're going to be small. They're like monthly car payments or monthly mortgage payments. They're small and going to be under that $10,000 cap. So I still think it fits the niche. And I don't know this to be a fact, but I would assume that they have a direct draft repayment program where you can put it on autopilot, just like you would to a normal bank. So paid up additions flexibility. This is kind of an interesting way that they're setting this up. They have a scheduled paid up additions rider. So scheduled in the insurance industry just means that they're expecting you to pay that premium. You kind of have to work with the carrier if you're not going to pay the premium that they're expecting. So they have some flexibility where, let's say that you're supposed to pay 10 and you end up paying 7,500. That's okay. That's within their range. The same thing on the high side. They're expecting 10 and you pay 12 and a half. That's okay. But outside of that range, in order to pay that amount, you have to work through your agent or go directly to the insurance carrier to effectively get that draft approved. Another thing to understand from a limiting factor is if you don't pay at least that 75% of what's planned or expected, you don't pay that, you lose the ability to fund. So without that specifically being requested to be lowered and deliberately pay less for multiple years, they may just remove that option and remove that higher cap, lower the cap to where now you can't go back up. You're kind of pigeonholed into the way that you've been funding. Now they do have a backfill catch-up provision, but it's fairly limited. And it's dancing around this number of that less than 75%. So you can catch up the difference if you funded less than 75% of what's expected of you in that policy year and then moving forward. But if you don't catch it up, the option for future catch up is removed. So they've got some little things in here where if you don't play by the rules and do exactly what they say, they're going to cut you off the knees. We've seen some other carriers work very similarly in the PUA space.
Yeah, but usually the companies that are a lot more strict have a lot bigger balance sheet. So
Yeah.
I don't know. I'm scratching my head as we're going through this to be like, okay, I'm really curious to see the summary of this of like, where does Security Mutual shine? Because it's not like they don't shine in a lot of areas. It's just there's a lot of things that are like, yeah, these PUA riders don't feel very flexible as you're going through them.
Yeah, that's fair. When we start looking at the other way to do it, it is much more flexible. It's a combination rider, but the limiting factor is if you use a lot of that flexibility in the blended PUA rider, you just can't fund it as long. So what's happening is, let's say for discussion's sake, we've got $1 million of blended term insurance on this policy. All right. If you want to pay extra into that blended term, what you're doing is you're paying more in paid up additions, and that's generating permanent death benefit and decreasing the actual amount of term insurance you're purchasing. So think of it as like a gas tank. It's full. You got all of that term. And over time, you're stepping on the gas, you're putting in more paid up additions, and eventually that's going to hit empty. When that hits empty and all the term is gone, you can't put any more PUA into the product. So it's highly flexible for short pays. But for long term, you end up with just a base funded policy once that falls off.
Yeah. So I wonder, I'm curious what the go-to for infinite banking is. I would assume it's the traditional PUA rider. And then
Yeah.
obviously the goal would be to fund proper like max fund. It's just weird to me that you would need to get approval. I just from a client experience standpoint, doesn't sound like a great client experience. But maybe I'm missing something. And who knows? It could be an advantage because clients could it might create a little bit of friction for them. Like sometimes flexibility is not a great thing. So who knows? But overall, let's continue. And yeah, no, it's
Okay.
thank you for breaking down the PUA.
Yeah, absolutely. So I think in summary, I'd say the combo rider is really designed for short term funding or people who have very flexible incomes that they may want to leverage, like a sales commissions person, right? That could be a great place for the combo rider. The PUA, that's like a financial tool that you're funding for a long period of time. If you want to do the steady Eddie, let's say, it's probably the PUA rider. So two things that I just find interesting that I think it's helpful to know is that one, they have a waiver of premium that does cover the combo rider. So what this means effectively is your waiver is attached to the cost of insurance. But what they allow you to do, even while your premium's being waived on the combo rider and on your base premium, you can still put in pay up additions. A lot of carriers, if you go on a disability waiver claim, they don't let you continue to fund the policy in paid up additions. And so that was just kind of a unique feature that I wanted to point out. The other one is they are Security Mutual of New York. So they do work in the state of New York, 50 states, including DC. And to come into the advantages section. So as we start to land the plane with this particular company, we're looking at a strong dividend paying history, 133 years plus. They are extremely, very, very pro IBC, the only carrier we've covered at this point that is this straightforward with saying, hey, we want to work with you. So if you want to be wanted, Security Mutual wants you, which is an interesting thing. They do have two good options for PUA. I think there's some limitations to each, but in general, I like them. I think they're good ways to fund these policies if you pick the right one and build the policy correctly. And then the last, and this is a real advantage to Security Mutual, out of the gate with that 10-day lightning fast industry leading loan initiation is very strong.
Yeah, I would just say love the dividend history. I love the that they're very pro IBC. I think that's an advantage. It's interesting because in this series you tend to give PUA riders like you tend to be that, and I don't know if I would put this in the advantage category, but yeah, you can overfund with PUAs. I don't know how crazy flexible they are, and then when it comes to lightning fast loans, awesome. I don't necessarily see their loan payment like the fact that they limit some of the online things to 10 grand is interesting to me. But like you mentioned, there's other ways that you can take loans and pay that back. So overall, I think that there's a lot of things going on. It's fun how like in every pro, there can be a con to every pro, and every con there can be a pro.
Mm-hmm.
So
yeah,
that's what I would say there.
All right. So considerations with Security Mutual, most of them are centered around the size of the company. So they're extremely small mutual insurance company. Size doesn't always matter, but sometimes I feel like it should. So it's larger clients putting in lots of premium in this particular insurance company. This might not be the right place to go. This also, thus far, is the highest lapse ratio we have seen with any insurance carrier that we've looked at. Now, there's one that I'm eyeing that I'm trying to get more information from. We don't currently work with. That's close to double this. So it's not the worst, but there's still something to be said there. On their insurance ratings side of things, guys, the fact that they're too small for a Comdex score, it just means that as an agent, if you really, really want to know the depths and the aspects the insurance company is not going to put on the front page of their paper, you got to go digging. And that's what we ended up doing with that Weiss rating. And the Weiss rating itself was a little concerning. It's a C minus, which indicates weak liquidity and only a fair stability outlook. So I think from a liquidity standpoint, we kind of talked about that, right? It's the large loan balance that they have, and they don't have a time frame of when that's going to be repaid. So I can see why that's there. Fair stability, who knows what that's from? I didn't dig into the depth of their financials at this point. They also have what I would say just a performance lag, right? So the average lag behind other insurance carriers really starts to show after about 5 to 10 years. And I think this is because they pay a smaller dividend, they have smaller guarantees in general. And so that product and that competitive nature falls off over time. First 10 years, they're right in the pack, right? Long term, as we'll see with the comparison, they definitely start to lag. So the big risk here, in my opinion, guys, is the niche risk. When we look at this insurance carrier, we have larger than average policy loans, as we've mentioned several times, about 4.5 times larger than average. This is a liquidity risk. And then we also have 10 times smaller average policy size than other renowned mutuals. The average among every mutual that we've reviewed, when I look at all of them, for the average amount of death benefit placed per policy was about $640,000. This insurance company is coming in at $63,000. So it's a tenth of the size from the policies. And what this says to me is they do perhaps volume, smaller policies. What that does to an insurance carrier is it decreases their margin. If you can have 10 clients paying you $10,000 a year versus 100 clients paying you $1,000 a year, it's the same money, but a lot more servicing. So to me, that is a niche risk to consider.
Yeah, and potentially goes into their higher lapse ratio. You just that is factored in. I think the niche risk is something that I'm glad that you mentioned. I think it just shows the level of detail that you went into this, and the fact that you found ratings that they're not necessarily publicizing on their end. I don't think any insurance company would publicize a C minus. Obviously, I agree that with that being very small, again, you could look at that as a positive, but overall, that's why we put it on the considerations. And then the performance. That's a big thing for me is when I'm looking, it's like early cash value. That matters when we're looking at something like this. When are break evens? And then the death benefit, is that increasing? And then over time, what is the IRR? And again, just to be super clear, every company projects a little bit different, but let's just say a 1% difference or a 1.2% difference over time can be pretty large, pretty large. And so overall, that's I think that you had a great summary here.
So a couple things to understand about the agent perspective. So compensation with this particular carrier, from what I've been able to see, is actually fairly low compared to the industry average without hitting certain production levels, right? If you do a lot of business, there is incentives and bonuses within their structure, even for brokers. But on the initial, it's fairly low compensation. I can't speak to the career system if they have one. I don't actually know that. On the resource and support side of things, while it is a small company, because they are so niched, if you're an infinite banking practitioner and you want support from the carrier to teach you to sell their products and speak the language, this might be the optimal carrier to do that at, because they have IBC specific materials that can be shared with clients. No other carrier is doing that to my knowledge. Some carriers mention it internally. Again, Security Mutual is very forward about their stance. On the product side, as you learn and as you grow in this industry, if you go with this carrier, I would rate it about a 6.5 on the complexity scale. The reason for this is really the nuance around the PUA. When the catch up is possible, when it's not, the percentages you can fund, if it's a scheduled versus the combo rider, how long you can fund. Those things, there's just a little bit niche and nuanced. So that's something I think would be a little bit more complex as you get into the industry and start coaching clients. The last, software illustration is actually good. It needs to be updated. I always say that for practically any carrier, so I'm not singling anybody out, but I didn't have too much of an issue with it. Now, to land the plane, finally, we've arrived. The key takeaway from Security Mutual is they have a solid lineup of whole life insurance products, and they are reasonable in the premium flexibility and the cash value growth over time. So utilizing them for IBC can be fairly good. However, I think the big issue, the concern, is the reported lapse ratio, the size of the company, that WEIS rating. And when you bundle all those together, there's enough pause for me as an insurance agent to not feel totally confident with selling this insurance product.
Yeah, so we're very public with where we are independent. We choose to work with lots of different carriers. While Security Mutual is on that list of carriers that we have access to, we right now are choosing not to make them a go-to carrier for us. That doesn't mean that we can't review Security Mutual policy. If you have one that you want us to review, we'd be more than happy to do so. And that doesn't mean that things will change in the future. But as of right now, it's not one of our go-to carriers that we have in the mix for some reasons that we mentioned in this presentation. I think we want to be, again, as honest and authentic throughout the process. And so, which leads me to, if you are looking for a policy review, you might be watching this and have a security mutual policy or have a policy from a different carrier, and you're interested in learning what our take would be. We'd be more than happy to review that policy for you. And if you found this content valuable, if you've been enjoying this series, and if you're just, grateful that there's people out there making niche insurance content, like this video, subscribe, let us know in the comments. If you're subscribed and you want to see our summary video, hit the notification bell. All of those things just tell YouTube, hey, we enjoy this channel, and YouTube will put us in front of more people that need to see this content.
Awesome. Well, Caleb, thank you so much. I've had a lot of fun doing this series. We've got about 3 or 4 other carriers that we're trying to get additional information on. We don't actually work with them, but we're trying. So we may end up doing some more videos, but for now, it's the last in the series. So we've got a summary video coming up for you guys really soon. We'll see you on the other side.
If you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company conduct scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment.